Hello and welcome to another March to a Million podcast with your host, Greg DuPont. I'm RJ Malik, producer of this podcast. Greg, how you doing today?
RJ, I'm doing great. How are you doing?
I'm doing okay, and I see, you send me a preview of what we're going to discuss, and you'd like to share some lessons from 2025, 10 to be exact. So why don't you give us a little preview before we get into this edition of March to a Million podcast?
RJ, I've got one of my mentors shared with me once that, if you don't look back a year in the past and say, how stupid I was back then. It's another way of saying that we learn every year, right?
Yes.
And at the end of each year, I like to sit and look back and say, how stupid was I at one point in time, and try to go from there. And part of our life is, learning those lessons. And so in terms of markets, investments, and all that good stuff, we're going to share some of those observations or lessons from 2025, now that we are soundly into 2026.
All right, sounds good. So do you want me to kick off what lesson to start with first?
Yeah, why don't you take it from the top?
Market reality check. So why don't you talk to us about the market in 2025?
So if we look back, it's one of these fundamental things about the market and investing, that the economists have correctly predicted none of the recessions, right? But each one is on the horizon, and the market is always humbling those who think they know what's going on. And 25 was no exception. However, there was some anomalous actions. There was growth throughout the market that many people did not see coming, did not predict coming. The tariffs were supposed to take the wind out of our sails, and next thing we know, it just keeps chugging along, even in the face of AI and all this stuff that's coming here that is forcing the change of our economy right in front of our eyes. And so when we think about the past, what the industry does is use the past as a predictor, although they always disclaim, right? You can't use the past as a predictor, but they do it anyways. So what we need to understand and reinforce from 2025 is, number one, the experts really don't know what they're talking about, self-included, right? All we can do is follow trends. All we can do is make our best predictable decisions. And by the way, that's what AI does, right? It sees the trends and it predicts what the next logical step is. So when we think about the market from that perspective, we have to be cognizant to what does history say is the next likely outcome. And when we look at that, we look at and say, okay, just because this year was a good year for tech stocks, next year is not going to be necessarily the same thing. We might have runs. We do have runs. That's historically, it does that. But just the same, when you look at something like Bitcoin, cryptocurrency, that went from boom to bust, right? Those things are out there.
Right.
So, the takeaway on all this is, the trends are things that you pay attention to that try to guide you. But overall, throughout the course of the year, the theme that keep coming back is we need true diversification. Just because crypto is running wild doesn't mean I need to stay in it. Good friend of mine runs his portfolios with having a good slice of that in there, but he shares with me that when he does that, they have discipline. They have rules and discipline as to when are they going to take their winnings and run. So what's the rule of pig, right? Hogs get fat, pigs get slaughtered, right? Whatever that is.
Yes.
And that's what really we need to be mindful of with the market.
You need to be a hog and not a pig.
That's right.
Okay. Sounds good. All right. Next on our top 10 list here, we're going to talk about inflation. And, a couple of years ago, inflation was out of control. It seems to be quieter. What is your take from 2025?
Depending upon what your measure of inflation is, it's quieter. We're not where we were before. But there is still pockets where it is very powerful. Uh, and what we need to understand is we are almost back to where we were in '08 in terms of potential deflationary pressures.
Hmm.
When the 70-inch OLED TV that I just hung on the wall is $1,000. That's great. I'm buying it. When it was $7,000 4 years ago, I'm not buying it. That's been deflation in that sector. Okay. And we look at across the board, there are things that technology has deflated the cost of. But when it comes to staples, where we have supply and demand being the primary culprit of that, of the pricing, we see milk went higher. Well, now it is smoothed out. Eggs, which was the famous one, right? How expensive eggs were. Well,
Yeah.
a good part of that is because the government destroyed a lot of the supply. Okay, we won't go into that, but the core is the inflation is under control. It's not where we want it to go from policy perspective. From consumer perspective, we'd like it to be gone. We like the 7,000 OLED is now $1,000.
Right. Right. But you'll always have some sort of inflation.
Will we?
You think there's a possibility of having zero inflation? Because I can't remember in my lifetime ever an economy with zero inflation.
We have never had that. However, we are we're heading into unprecedented times.
Okay.
And I'm not going to declare what the outcome is. I'm going to watch it happen unfold in front of us. What does the world look like if we have unlimited energy? What does the world look like if we have the robots doing the work for us?
Right.
I don't know. And when we think about what are the things that we need in our life, food, shelter, etc., does that always need to increase? Is it really good for us when the cost of housing inflates from year to year? It's great if you own the house. Not so great if you're my daughter trying to buy a house.
Right. We sort of ran into that with where we are here in Jersey and what we bought 8 years ago, and the price has gone up, and we're like, oh, this is great. But where we're looking to go when we, slow down our work life, the prices have also gone up. So it's a no-win situation.
I hear it all the time in our retirement conversations. Greg, I'd love to sell my house. It's too big for me. I need a single floor, but where are we going to go?
Yeah.
My house that I bought for $150,000 is now worth $500,000. I can't replace it for anything less than $700,000.
Right.
It's again, it's appreciation when we own it. It's inflation if we're outside looking at it.
Okay. All right. Let's move on to retirement success equaling resilient income.
Almost against the backdrop of that inflation, right? What is most important for people? To be able to live their life the way they want it and have the income necessary to buy those things going forward.
Sure.
And again, going to the OLED example, right? When I bought it for $7,000, it was a big expenditure. $1,000, it's an impulse purchase. If I've got consistent, reliable income, which is the core of our working life, then I can live my retirement life peacefully.
Mm.
If I need to be shucking and jiving, moving things around to try to pull this principal out, to take this gain off of here and all that stuff, that adds a layer of stress. And the more and more that I see people in retirement that live those two paths, the more I am certain of the path of comfort that comes with having that steady income going forward. So that allows you to be more resilient. When the market's down, you don't need to be trying to figure out how the hell do I sell at a loss and mitigate that. You just know that you've got steady income coming through so you can ride out until the market comes back up.
All right, sounds good. All right, let's move on to our next topic here. Housing, and we sort of touched on this, housing big assets, limited flexibility.
Yeah, I
We
guess I
did,
did foreshadow that, didn't I?
yeah. We're both, you're living it through your daughter, and my wife and I are living it through the fact, as I touched on before. We're in Jersey, but, Cape Cod is our special place, and that's where we would like to spend the rest of our time together. But the housing prices have just gone crazy here in the Northeast.
I have a friend of mine that spent 2 years trying to find a home for his family up there, right? He was renting throughout that time just because they couldn't find a decent property that they can get in at the right time.
Right.
And again, you also again, to the flip side of that, as I was talking about a little while ago, if you sell, what are you going to move into? And part of the problem that we have as an economy right now is people that are locked in at those 3% call it interest rates that know they can't go anywhere without substantially increasing the interest rate, which, if you go from a 3% interest rate to a 6% interest rate, that $500,000 home costing the same as a $750,000 home, right? And so inventory is stuck because of that. And hopefully we'll find some solutions. There's some that are out there that they're trying to get through, to break through that, to make it open up some opportunities for people like yourself trying to find next home.
Okay, very good. Diversification means true risk offsets. What does that mean?
When we think about diversification, typically in the investing world, all the advisors are talking about are stock and bond, right?
Right.
Maybe a little commodity, depending upon whether or not your guy is independent and, well, shall we say, more esoteric. I'm gonna like my friend I was referring to that has some Bitcoin in his portfolios that he runs for his clients. And with that diversification, I add the layer of guaranteed, right? That we know that we're not going to lose value on this stuff. Diversified into, as we were just talking about, income producing versus capital preservation, right? Those are other layers of diversification that really, when you build out and add those other layers of diversification, now we're able to truly offset the risk that's out there.
Mm-hmm.
We had a position in Bitcoin and it's dropped down significantly. Well, again, if we needed it, we're in trouble. But if you don't need it, and because you've got other stuff elsewhere, then you can wait for that to recover. Put whatever you want to do in terms of that title where I've got Bitcoin, put gold, right? What happened to gold? Those type of commodities or any type of investment. You've got to have true diversification, not just market-based diversification.
So this way you can write out a segment that is having a rough time and not panic.
Yeah.
Okay. Very good. Very good. All right. As we continue on with the lessons from 2025, next one is trillions in cash are a problem and an opening.
Lots of people were worried. Lots of people are worried. Lots of people, those worries manifest in parking cash on the sidelines. Trillions for that. Yeah. And again, we talked a little bit about supply and demand.
Right.
So, well, when that stuff starts coming into any one of the markets, we saw that in gold recently. That cash went into gold as a hedge. And what happened? The price skyrocketed. That dynamic is going to play out repeatedly over the next couple of years as we continue to work to absorb the massive amounts of cash printed by the Fed as a result of COVID that hasn't been sucked back into the system. It's just kind of sloshing from one place to the other. And it's where it wants to focus on because there's opportunity that we see now, tremendous growth, and then they back out and move it somewhere else. That's what the big money is doing. That's what's going on behind the scenes.
You're constantly watching where the money is going. That's part of what you do as far as with your clients?
RJ, I'd like to say that I do,
Okay.
but I don't. If I were a trader,
Okay. That's not your job then.
yeah, those are the type of ebbs and flows that I would look at. Where's the money coming from and all that? And those are the type of people that, milliseconds makes differences. I had the honor of being sent to the stock exchange a couple weeks ago to go down into the pit there, and it was interesting to watch. And that's what traders do, right? They watch those flows of funds and they jump in and jump out. Investors need to kind of take a step back from all that stuff.
And watch the big picture.
Yeah, because they don't have the ability, and so they end up getting whipsawed. One of the curious things that I observed when I was on the floor of the stock exchange a few weeks ago is just how much of the floor of the stock exchange is dedicated to media.
Oh, okay.
Not the actual trading. That's all done behind the scenes. But media dominated that floor.
Putting on a show.
I think it's a reflection of where we are.
Is that a good thing or a bad thing, or it's just the way it is?
It's just the way it is. And if you're not paying attention to those type of things, then the financial educators, right? They get your eyeballs, and next thing you know, you're maybe making some poor investments.
All right. Moving along on the top 10 lessons from 2025. Deaths in the United States in 2025, they increased.
Yeah, it was a kind of an interesting statistic that jumped out at me, and I think it's going to be, number one, it's a reflection of our aging population a little bit. But I'm going to go out on a limb and say that's a high water mark.
Okay.
That I think in as we go forward with all of the changes that are coming down the pipeline with medications and such, I think that we've hit a high water mark as a percentage of population passing away.
All right, that's interesting. We'll see how you are as a prognosticator.
Check back with me in 3 years.
Okay.
5 years, 10 years.
Now, this is a topic that I think is starting to get a lot of daylight. The great wealth transfer raises the tax stakes.
Yeah, have you followed what's going on in California with the proposed billionaires tax?
Yes.
I know you followed it because you're intimately scared that's going to happen to you.
Well, look where I'm located,
Yeah, that's right. Yeah. But, the long and short of this is, that now the politicians are taking more action to generate revenue in certain states.
Right.
Because they've recognized that they are maybe they have recognized, maybe I give them too much credit, but they are in a mathematical death spiral. And they got to find ways to juice that. And so California is talking about some very draconian taxes that they're going to try to impose upon the ultra rich that will now move to Florida and benefit Florida.
I guess common sense, if you get into politics, common sense goes out the window because I'm not the brightest guy in the world. I have average intelligence, and even I can figure out if you keep raising the taxes on the wealthy people, especially in this day and age, you can move and still basically live your same life almost anywhere in this country.
Subject to, and this kind of takes us back to our earlier chat about real estate. If you got a $5 million home in LA, how many people are going to buy that home? Right? But ultra wealthy, they've got properties here, there, and everywhere. It's the RJs of the world that can't move out of their house. And next thing we know, the property taxes continue to rise. And then you get into the position that my parents were. We grew up in a wealthy suburb here of Columbus. And at some point, the house appreciated so much. The utilities were high because it was an old house. And then the property tax. So altogether, it forced them to sell, right? And that's, money moves. Ultra rich money moves very efficiently.
Right.
Most of the people that we talk to, they can't be that nimble. And the takeaway here, what is the prime target for those tax raisings? The 401ks, the IRAs. It's a sitting duck.
That would really aggravate me because my money that I put in there, well, it wasn't taxed. But at the same time, I'm saving for my future, so I'm not a burden on the government and on society. I'm doing my job to take care of myself, and if they're going to penalize me for that, that's not going to sit well with a lot of people.
You were a good steward of your money. And when you look at that savings, that's not a number. That is 30 years, 40 years of your life reflected in that. And when they come through and they take 25, 30% of that in taxes, that's 25, 30% of your work life being lopped off.
Right.
And, money that, yes, you want to support your family, yourself, not be a burden, and you want to leave it behind. And that's why being able to manage that, to maybe bring in other strategies to change the structure of our savings are so powerful and so attractive to many of our clients.
So you can change your structure, okay, as you're heading into retirement. We'll use me. I'm 64 years old, so I'm looking to work until I'm 70, full time, and then slow down after that. I'm not sure if I'll ever stop because I enjoy what I do. But is it too late for me to change my strategy at my age?
It's never too late to make changes to your strategy. Let me give you an example.
All right.
I see this a lot with people in that scenario. They're still maximizing their contributions to their 401k, maybe well in excess of the match that their employer, maybe the employer doesn't even give them a match.
Right.
And they start talking to me and say, I hate this idea that I'm going to get taxed on this. Like, oh, wait a second. Why don't we take a little bit of pain now? Why not save that differently now? Why not put it into a Roth 401k? Why not just put it into a brokerage account so that you have paid the tax piper now?
Interesting.
So for yourself, RJ, for the next 6 years, if you were contributing, call it $10,000 to your 401k, instead sending that $10,000 to a Roth or whatever, you're saving maybe $2,000 a year in taxes, depending upon your bracket, by putting it in your 401k instead of into a Roth. But maybe, just maybe, you're better off paying a little bit more taxes now and having that pot that never is subjected to it in the future.
Okay. All right. Let's move on to rates, taxes, and behavior are the new alpha. What do you mean by that?
Well, it really kind of comes back to what we were just talking about, really. Yourself doing arbitrage on your tax rates. You're probably in the 22% bracket, regardless of which way you go with that, right?
Right.
And so is it better for you and your family to pay a little bit more taxes now and save for later? When I start doing projections and the plans for the future, everybody would love to be in a position where they are tax-free in the future. And a lot of advisors try to sell that dream. I don't particularly push that dream. But here's what I do look at. I look at, what is your lifestyle cost? How much is it going to cost to live your life the way you want to live it? And as we look at on the horizon there, when the RMDs come in, is that forcing you to take out so much more than is needed for your lifestyle cost? Getting back to the $10,000 a year. Maybe, just maybe, pulling out that money, putting it into a Roth instead of putting it into your 401k. Now, when you're at 75 for folk like yourself and have to take RMD, well, that 60 has not turned into $200,000 of IRA money that's now pushing you to take more out than you need.
Okay.
So being able to be efficient in targeting what our income needs are, where are we going to get the money from? Little savings can add up and make huge differences throughout a retirement, as we talked about on this show regularly, that I believe for folk like you and I is going to be 40, 50 years. Well, you're not retiring, I'm not retiring, but you know what I'm saying.
Yeah, no, we're not.
A much longer period of time with compound effect.
All right. And we are up to our last lesson, and this gets my blood boiling. And if I had hair, I would be ripping it out. The U.S. debt. It just annoys me that we are in this situation. And looking at it, my perspective, my opinion, it's unnecessary that it's this high, and it's a failure of our representatives.
You know, I would love to say reasonable minds can agree that rampant fraud and abuse is something that should be carved out of our system. But when we see the numbers, we see the actions, and start trying to put the pieces together, how that's all reflected on our national debt, let alone our deficit that you know, when we started, those of us like myself that tend to be, shall we say, more from the right, as we watched Doge and what they were looking at in terms of fraud and abuse and all that, and it just seems like so much money can be carved out of that.
Yeah.
And if we look at historically what our debt to GDP ratio is and all that stuff, you know, there seems to be a path that should be acceptable, but our representatives can't get us there.
You would think, and you and I probably could go off for a long time going over this topic, but yeah, it doesn't seem difficult to me, and it sounds like it's the same for you. But here we are, and I don't know how we're going to get out of this.
How can we look our kids in the face and know that we're promising a future where we're adding trillions of dollars of national debt every year just so we can feel good about ourselves?
Yeah, well, I'm sorry we're ending a little bit on a downer here, but before you go, how about some contact information?
So if anybody wants to reach out and get a hold of me, the best place is to take a look at me at LinkedIn or go to my central website, which is www.gsdupont.com, let alone Advocate Wealth Solutions. So I'm out there. You can give me a call, 614-408-0004.
Sounds good, Greg. Thank you. And if you've not subscribed to the March to a Million podcast, make sure you do that. If you know of an estate planning attorney, financial advisor, or a client who really needs this information, please make sure you share this podcast with them. So for Greg DuPont, I'm RJ Malik, and we'll see you on the other side of the mic very soon.